All right. Hi, everyone. We are live. Welcome to Market Matters. My name is Katie Kuntz, and I'm a social media editor here at CNBC. I'm joined by our senior markets correspondent, Bob Pisani, and today we're going to be answering all of your questions about the latest stock market moves. How are you doing, Bob?
A little tired. It's been another difficult, chaotic week, but hopefully we're getting a little more clarity. So better today, I would say, Katie.
Yeah, well, I'm sure you've been busy, so let's dive right into it. First up, Bob, what's been driving this recent stock market volatility?
Well, look, it's tariffs and attacks on the Federal Reserve's independence. We're getting a little clarity. What looks like appears to be happening is Scott Bessent, who is highly respected on Wall Street, who's a hedge fund manager for many years, is sort of trying to seize control of things. And the two issues, of course, are tariffs on China, which appear will be coming down. Some reports, are considering slashing tariffs a lot, but we don't have any details. We have what looks like body language that wants to tone down the rhetoric and make a deal with China. And then we have the old issue of, the president picking a fight with Jerome Powell. And now saying, after implying he might want to try to fire Powell, first off, it was never clear that he could. Powell insisted that he didn't have the grounds to do so. And most people agree that he didn't. But independent of that was just, why do we need to create this controversy? The stock market has voted very clearly on this, and investors have voted very clearly on this. They don't want a war between President Trump and Jerome Powell or the Federal Reserve. Investors believe in the independence of the Federal Reserve. It was created in 1913 to independently deal with short-term interest rates and help control the economy a bit. The Fed only controls short-term interest rates, and investors want to believe that those rates are not going to be influenced by whoever's in the White House. That's what they want to believe, and everyone wants that. In Congress, there's unanimity around this. The other thing that's really frustrating about this is the president tried to create a war with the Fed that wouldn't have changed the policies at all, because there's 12 members on the committee that set short-term interest rates. This is the FOMC, the Federal Open Market Committee. Powell is only one of them. There's 5 regional presidents, including the New York Fed. There's 7 members of the Federal Reserve Board, including Powell. Those other members, those other 11, would have been there anyhow. They certainly would have not been happy to try to attack their independence. So it wouldn't have, I don't think it would have ended up doing anything anyhow. The result of all of this, if you ask what's the outcome, is the president will probably try to blame Powell for any downturn in the economy. But anybody can see through that. Investors see through that. Resolving the trade dispute is completely in the hands of the president, not in Powell. And that is the number one policy problem and policy mistake investors are saying have been made here. Most investors going into January and February, we were looking at a modest 10% downturn, partly on a slight slowdown in the economy, partly on a fairly richly valued stock market. 10% is a garden variety correction. That's not even much to write home with. But because of this tariff craziness, we have the possibility of pushing the global economy into a recession because of this. And it could all change on a tweet. This is why investors have been a little crazy in the last month. April has not been a good month. The good news is we're almost back to where we were before these retaliatory tariffs. That was April 3rd. Not quite, but we're better. But we're still down 9% for the year. So if you ask what happened here, what do we learn from all this? Number one, we learned that the president's pain threshold is higher than we thought. But there is a pain threshold. It is there. And he's obviously hit it. Number two, what we learned is this fundamental investing lesson, which is it's very bad idea to try to trade around this chaos. You can't do it. So you have to stick to a plan. You have to stay diversified, and you don't try to time the markets. I mean, can you imagine trying to sell like 2 weeks ago and now the markets rally back? Don't you feel like a fool? That's why doing nothing generally in market panics is a good idea. Generally, doing nothing is the best course of action. And this is why diversification matters. It helps in downturns. You don't just own technology stocks. You own bonds, and you own maybe some gold, and you own defensive stocks like Coca-Cola and Johnson & Johnson. Those are the things we've learned. With all that said, there's a lot of damage that's already been done. The dollar is weaker. Generally, we support a stronger dollar. The idea that U.S. Treasuries are the global safe haven in the world is sort of been damaged, is under question. And our trade partners and our allies are having deep doubts about how reliable we are. So there's already been a lot of damage done. So what makes investors crazy, just look at how the market is reaction, is most investors feel that this was not necessary, that there could have been pressure put on China in more subtle ways that wouldn't have caused all of this chaos. That's why I think investors are very unhappy with the way things are going. I think most investors would support the idea of a negotiation with China on trade policies, but not done like this.
Well, things seem to be changing very quickly, Bob, so we will definitely be keeping a close eye on the markets and what's happening there. Next up, what is stagflation? We all have heard of inflation. So what's stagflation and what does that mean for investors?
Stagflation is a situation where you have high inflation and the economy is not growing. So the reason this is very bad news if this happens, and it did happen in the 1970s. And the reason is, think about it this way: if you have 2% inflation, which is where we were a few years ago, before the COVID thing hit, but you're growing at 3% a year. Well, you're still growing at a real rate of 1%, 3% growth minus 2% inflation, growth of 1%. You'd like it a little stronger than that, but it's still real growth. In stagflation, you could have 4% inflation, 5% inflation, even higher in the 1970s. And you may have an economy that is flat or not growing at all. So if you have 5% inflation and 2% growth, that means you're having 3% negative growth, 5 minus 2. That's not good. You want to be on a positive side. So that's what stagflation is. And it's a real drag on the economy. And that did happen in the 1970s for a variety of reasons. So this presents a real problem for the Federal Reserve, because in 1977, the Fed was given a dual mandate. They were given the mandate to fight inflation and to keep job growth strong. Now, you've got a real problem in stagflation with this dual mandate, because if you try to reduce inflation by raising interest rates, that's the standard way to do it. You raise rates and it reduces demand, inflation goes down. What you do is you further slow the economic growth and you increase unemployment. Well, you don't want to do that. And if you try to boost growth, if jobs are weak, you try to boost growth by lowering interest rates, you can worsen inflation. You see, you're damned if you do and you're damned if you don't. This is why you don't want stagflation. General way to understand this: you want growth to be stronger than inflation. If the GDP is 3%, inflation is 2%, you got 1% positive growth. You want to be on the positive side of the ledger. Stagflation means you're on the negative side of the ledger. You don't want to do that. You want to avoid that. And that's why people freaked out on the tariffs, because they're inflationary. The market believes they are inflationary. And that inflationary, on top of reducing the economy, throws you into the potential of stagflation. This is the thing that really bugs people about this aggressive approach to the tariffs.
So, Bob, we've seen stock prices going up and down. What's happening with gold prices?
Well, there's two things with gold. The first is gold is, by some people, considered a safe haven because it's a store of value that is alternative to owning stocks or bonds or real estate. I happen to agree with this. Gold has at times in the past been used as money. Money, one of the definitions of money is that it has some kind of store of value that doesn't just evaporate on you. Gold has been a store of value for several thousand years. So it's not irrational for some people to think about owning gold. I have disputes with people who say gold is a hedge against inflation. The answer to that question is sometimes it is and sometimes it isn't. It's really a sentiment indicator to a certain extent. But I have no argument with the idea that gold is an alternative store of value. I think that gold has proven itself to be that over the centuries. Another reason gold is going up is who are the owners of gold? In the past, most of the owners of gold in the world, the primary gold owners of gold were Chinese consumers and Indian consumers. Indian households use gold as a significant part of their household wealth. They actually own jewelry as a part of their wealth. and they're significant owners of the gold around the world. The other significant owners have been in the last 20 years ETFs. It is now possible because of ETFs to own gold in a vault somewhere, and you pay them to own it, and you can safely own and store it. This sort of removes the need for you to have gold coins in your basement or in a vault somewhere. Somebody does it for you. So you have, number one, private ownership of gold around the world that has been fairly stable and in some cases growing. You have the growth of ETFs that allows expansion of private ownership. And another group that's become very important is central banks. They used to be a fairly small part of it, and they held gold primarily just as a reserve, an alternative reserve. But there have been many central banks that are seeking to reduce their dependency on the US dollar, partly because of all this chaos that we're seeing. And so one alternative for them is to own gold. So central banks have themselves been owning more gold. And so the supply of gold is fairly steady. The amount of mining of gold that's done around the world is fairly steady. So from the supply side, you have fairly steady. But if you get slightly higher demand from central banks or private investors who want to own gold as a hedge against chaos, or you get Indian investors who are, if the Indian economy expands and traditionally Indian investors own more gold, they'll buy more gold as part of their household. Remember, stable supply, demand goes up, prices go up. Supply and demand, okay? Supply stable, demand higher, price goes up. So when you're dealing with central banks and private demand, been a little stronger recently. So the rise in gold prices is not mystifying to anybody. Also, when the dollar goes down, it makes gold, which is denominated in dollars, more attractive for foreign investors. So there's a number of reasons why gold is up that make very good sense economically.
All right, Bob, our next question. What is the bear market and what does that mean for investors?
Yeah, here's a little surprise. There is no definition of a bear market. There's no committee of wise men that ever got together and said, oh, we're going to decide, that if the market drops 10%, it's a correction, and if it drops 20%, it's a bear market. Nobody did. It actually happened a little bit by convention and a little bit through the work of some technical analysts that go back 40, 50 years. There was a very well-known analyst, Alan Shaw, at Smith Barney, way back in the 1970s and 80s, and he sort of created this template to explain. Really, that was a way to tell a story with technical analysis, because just as a shorthand, what happens if the market drops 10%? Well, he decided to call it a correction, and when it drops 20%, a bear market. Now, again, there was no committee. He just started doing that with his clients, and it was adopted because it was a very simply just a shorthand for explaining the way things are. And it was a very good, simple story. But nobody ever made a decision on that. There was no committee vote anywhere. So let's say down 20% or more is from peak to trough is a bear market. We almost did that this year. From peak to trough, we were down about 19%. And that's a little unusual, but drops in the stock market are very common. I mean, you see corrections of 5% in the stock market 2 or 3 times a year historically, and you get 10% drops. Usually, I've been here 30 years. Usually about every year, you get a roughly 10% drop. That's fairly normal. 20% drops are a little less normal. I would say you get them every 4, 5, or 6 years, but they do happen. And by the way, this is why stocks have a high risk premium. In other words, investors are paid more to own stocks than to own bonds because stocks are more risky. It's called the risk premium. So, that's why they're more profitable over time, because there's more risk, because there's a risk of things happening like a drop of 20%. That's not going to happen in the bond market. That's probably highly unlikely. So if investors want to provide higher returns for stocks than owning bonds, then unfortunately, these kinds of risks, like a bear market, that's just the price. That's why you get paid more, because it's more risky. And by the way, this is why you should be diversified, right? This is why you should not just own 2 stocks, why you can't just own Apple and Nvidia. It's too risky to own 2 stocks. You're too exposed. This is why you own the S&P 500. Warren Buffett does not own the S&P 500. He owns Apple, but he also owns Coca-Cola, and he owns whole bunch of others. He owns Kroger. He's a value investor, but there's the value of diversification here as well.
Well, that's a great transition to our last question for today, Bob, which is, what should a beginner investor invest in for the long term?
First off, if you're a beginning investor, maybe you're 25 or 30 years old. The first thing you should know is you're going to live a long time. If you were 30, I will bet you your probability of living to 100 is quite high. That means 70 years. Think about it. Now, let me be more specific. I'm almost 70, just shy. I'm anticipating living to 90, at least another 20 years. Most of my friends who are actuarials tell me I'm wrong, that if I've made it now to 70, which I have, the probability of me living to 95 is pretty high. It's probably 30, 40%. So I may live to 95. So what does this mean? It means I have another 20 years left. So if we're down this year, let's just say we're down where we are now. We're down 10% on the year. Well, all right, that's not great. But the S&P rises 3 out of 4 years. And now it's had a down year. But in 20 years, none of this is going to matter. This is why I'm still invested in the stock market. People say, oh, you're 70. My gosh, isn't it too risky? No, I still own almost 70% of my 401k, still stocks, 20% in bonds, 25% is in bonds, and 5% is in a money market fund. So I have a very high risk tolerance, though, because I know a lot about the historical movement. Yeah, I know even if we're down 10% this year, in 20 years, it's not going to matter. I know I'll make that up fairly quickly if the historical precedent happens. Now, maybe we'll hit this bad spell for several years where we're underperformed. That has happened a few times, but it's not the norm. And I'm playing longer with the norm. But if you're 30 years old, you have probably 70 years. Down year this year isn't going to matter at all. The key to the game here is diversification. The key is knowing what your risk tolerance is. And the key is starting to save money early. The most important thing anyone could ever know about is compounding interest. Compounding interest means you make money on your money. Yeah, the stock market, on average, with dividends, makes about 10% a year. Now, it doesn't do that every year. So, as I said, 1 out of 4 years, it's down. But on average, do the math. If you put $1,000 in and it's a 10% return, that means you have $1,100, 1,000 plus 100. If the market is up 10% next year, you not only make money on that $1,000, you make 10% on the $100 that you made last year. You didn't even do anything. So now you've got more than 10% of $1,000. You have 10% of $1,100. That's compounding interest. And it doesn't look like a lot, but when you put that number out over 30 years, just go do a compound interest calculator. Just type one in Google, and you're going to see what 10% return is of $1,000 over 30 years. The numbers get really big when you get out further. That's the single most important thing for anyone to understand. So you only accomplish this by investing early. If you just do this for 2 or 3 years, you say, oh, okay, I got $1,100 and then I'll make $1,200 or $1,300 next year. It doesn't seem like a lot to me, but go out 20 years and you're going to see. So if you start investing at 25, there's a big difference between starting investing at 25 and starting at 35. That's what I did. That's the mistake I made. I didn't start really investing until I got hired by CNBC 35 years ago in 1990. And then I saw that I had made a big mistake. My whole generation totally screwed up because we didn't do anything in the 70s. We just had a good time. We hitchhiked around Europe. It was a great time. I had a great time, but it was a stupid thing to do. And I didn't listen to my parents. I should have. You should listen to your parents if they're hopefully giving you this kind of advice. So stay diversified, invest early, and do it consistently. And don't get blown off course by these kinds of crazy events. The stupidest thing anybody could have done here in the last month is we're down almost 20% and then start selling. That's not a smart investment strategy. It's buy low, sell high. It's not buy high, sell low. This is what happened in the great financial crisis. My entire generation flushed their savings down the toilet. It was the most depressing year of my whole life, 2009. Market was down 50% in a year and a half. 50%. We're down 10%, and people are screaming like crazy. We were down 50%. That was a catastrophe. And people were still selling in March of 2009. That was the bottom, March. Now, we didn't know that was the bottom. We didn't, but I was writing about it. When is the bottom? We didn't know, but there it was. I only knew that months later. And yet people were still selling. Selling down 50%. That is really dumb. You don't sell down 50%. You buy. but people act in the opposite way. This is why behavioral economics became so important. Behavioral economics tried to study the way people really act, not what they are supposed to act. And what they found out is people act irrationally against their own interests because this panic that's ingrained in our brains from tens of thousands of years of worrying about our survival kicks in, and you go into survival mode. Don't do that. Sometimes you have to argue against your own simple instincts. So start early, have a plan, stay diversified, and keep with it, and don't get blown off, of course. And you'll be like me. 35 years ago, I realized I was very late to this party. And here I am, almost 70 years old, and well, I'm not rich, but I'm all right. And thanks to a steady investment philosophy. It's all in my book, Shut Up and Keep Talking. And there's actually a chapter on what I own. I'm one of the few people that actually publish exactly what I own. Not surprising, it's index funds like the S&P 500. But if you want more, you can see it in the book. It's on Amazon. Shut Up and Keep Talking.
Well, I think that's very helpful perspective for people to have when we see these big swings in the market. I know it's been a busy couple of weeks, so thank you, Bob, for taking the time to answer our questions, and thank you to everyone who sent in questions. And we'll see you again in a couple of weeks. Thanks, Bob.
Thank you, guys. Take care.